I want to welcome you to the Troy Public Library Zoom program tonight. My name's Maggie Forrest. I'm one of the reference librarians at Adult Services at the Troy Library. And we want to thank the Friends of the Library for supporting our program tonight. What we're going to do with this format is Scott will speak and do the presentation, and at the end he will answer the questions for you. So you can put your questions down in the Q&A at the bottom, and at the end of the program, Scott will answer those questions. I want to welcome Scott White of Bloom Advisors tonight as he presents Let's Talk Retirement. Scott's no stranger to the Troy Public Library because he's come many times to present different programs on Social Security and other financial investment topics over the years. Again, if you have any questions, please put them down in the Q&A at the bottom of your screen, and I'll read those questions to him at the end of the program. And hopefully you'll get some of those your questions answered. Now I'm going to hand the program over to Scott. And Scott, go ahead and start the program.
Great. Thanks a lot, Maggie. Appreciate you having me on. And I always like to mention that I'm also a Troy resident. So it's always a fun thing to be able to present to the local library where I live. So we're talking retirement tonight. My name is Scott White. I'm a financial advisor with Bloom Advisors based out of Farmington Hills, Michigan. And I'm also a member of the investment committee. So I've been with the firm since 2000. So actually this October, it'll be 22 years for me. And I spent almost a decade prior working for Charles Schwab, the nationwide brokerage firm. And so that's kind of a little bit of my background. And what we're going to be covering tonight, kind of big picture stuff, expenses and retirement income sources. That's, to me, where the really important stuff is figuring out, how much you're going to need to live, where that money is going to come from, building a portfolio that works for you. So we're definitely going to spend some time talking about, what I think is the right approach to investing. And, also talk about some things that maybe don't make sense as well, things to steer clear from. And then we'll definitely want to spend a little bit of time talking about maximizing your retirement income, primarily by minimizing taxes. So there's definitely, in my book, kind of a better way to be drawing income in retirement. Most people have a variety of different accounts. Which ones you draw from have different tax ramifications. So that's an important consideration. And then we'll definitely spend some time with Q&A, going through questions. So as Maggie said, I definitely recommend that you pop questions up in the Q&A, which is just when you're in Zoom, click on a little note down near the bottom, the Q&A, just type out your question. And I may end up answering it as we go along, but if not, we'll kind of go through those one by one at the end of my planned presentation. So first off, again, expenses and income sources in retirement. So understanding your expenses, primarily, people kind of say, well, I have a budget, I don't have a budget. I would say while you're working, it's important to have a budget, but not everybody does. When you think about your budget in retirement, though, it's really not the same as your budget while working. So oftentimes, if you listen to whether it's a financial expert online or someone on CNBC or what have you, they'll say, well, hey, rule of thumb is 80% of your income while working. And I would tell you flat out, I think that's the wrong approach to figuring out how much income you're going to need in retirement. I think it's far better to sit down with pencil and paper and really look at what are your expenses. What is the mortgage paid off? If not, how much is that? Are you going to have a car payment in retirement? How much does your food budget run? And really add those up. And of course, you need to look at your budget realistically. So looking at your unique situation. Some people might say, well, hey, I travel a lot. I spend, $10,000, $15,000, $20,000 a year on travel and vacations. Well, that needs to be part of your budget. Other people might say, well, I don't vacation much. I just spend time with, kids and grandkids. Well, so you don't need to budget as much for that. But definitely important to zone in on that. And again, the rule of thumb approach, why I think that doesn't work for most people, is that when you're working, here in the Metro Detroit area, you're going to find that, most people are going to lose probably anywhere from 20 to 25% of their income towards taxes from, earnings. When you shift into retirement, that your tax burden for most people is dramatically lowered, unless you're drawing exclusively from an IRA account. And so the other thing too is, eventually if you're retiring around 65 and Medicare is kicking in, your health insurance cost is going to be dramatically different than while working. And the other thing, hopefully most of us are, deferring a portion of our wages into, 401ks to help save for retirement. And again, that's just another number that, if you look at your income and kind of do some ballparking on that, it's going to be very convoluted and difficult to do. So again, I look at it and say, build a budget, sit down with either a spreadsheet or at least pencil and paper and list those items out. Lifestyle changes can have a big impact on retirement expenses too. Oftentimes, questions that we get is, well, hey, I'm thinking of, leaving Michigan and moving to Arizona or Florida, somewhere sunny. Well, you got to take into account, is the cost of living going to be the same there or, more or less, and make some adjustments for that. And probably most importantly, inflation, which I probably don't need to remind too many people of that, right now with the way that inflation has been running on a lot of goods, whether it's just, grocery items or gas at the pump. But inflation is a very important consideration in retirement. You have to plan for your expenses to increase during retirement. Oftentimes, we're big fans around the office of saying that you need a rising income stream during retirement. The reason we say that is to keep up with inflation. Now, generally speaking, inflation runs about 2%, and it's been running at that average literally the past, 80, 90 years. There are times like right now where it runs hot, and, we're looking at inflation that's running, closer to 8% right now. And there's been times in the 70s, late 70s, kind of like the Carter era and the early 80s where inflation was running even hotter. It was literally like north of 10%. But by and large, inflation is kept under control, by a variety of mechanisms, and it tends to trend about 2%. And so when we look at retirement planning, we're really looking at that and saying that that's what we plan for. So income sources. So what are the main income sources? I like to mention pension, but for a lot of us folks, like myself included, a pension won't really be the primary source of income. Many workers are no longer eligible, or pensions may be frozen. I know that the big three went through that years ago. Literally, I think it's at least a decade, if not longer at this point. My memory serves, it was like 2003 or so when the big three started to freeze pensions, and then new employees that got hired on were really just offered a 401k instead. However, if you happen to be a teacher or some other profession that still offers a pension, you need to obviously take that into account. If you're eligible, it's important to look at your options. So sometimes you can choose a lump sum instead of a monthly pension. And that can be a consideration, but it's not always the best course. One of the things that we do with clients that come in is when they have the option to take a lump sum or a monthly pension, we do some analysis and run the math and see, which way is going to make more sense. There's not always the right way for everybody, but there's usually a right way for each particular individual situation. So there's something to be said about the comfort of knowing that you're getting a regular monthly pension. Although sometimes folks, especially if there's health issues, they don't think they're going to live necessarily long in retirement, a lump sum can be a better option, because most pensions upon death, they disappear. Or they may have a survivor option, which is good for a married couple. But the lump sum is kind of the way to ensure that if people don't live a long life, or a survivor doesn't live a long life, that you're retaining the value of that pension for your beneficiaries. The other thing to keep in mind is, does your pension have a COLA? And so those were exceedingly rare, which is just a cost of living adjustment. But if they do, hallelujah, it's a great thing. And when you have a COLA, that's going to allow you to offset some of the impact of inflation throughout your retirement time frame. So Social Security is a big one, and I do seminars specifically on Social Security. Well, I'll probably spend a whole hour talking about it. So tonight we're just going to cover some of the high points, big picture stuff. And but for many of us, Social Security will be the primary source of retirement income that's fixed and reliable and is going to happen. And with that, if you collect benefits early, you need to keep in mind that, and early is really age 62, that you'll receive anywhere from a 25 to 30% permanent reduction in your benefits. Usually claiming early is not the best way to go, again, unless you've got health concerns and you don't expect to live long in retirement. If you collect benefits at full retirement age, which age ranges anywhere from age 66 and 2 months to age 67, you'll get your full retirement benefits. So someone like myself, who was born, essentially in the 60s, my full retirement age is 67. For folks that were born in the late 50s, between 55 and 59, it's essentially 66, between 66 and 2 months and 66 and 10 months. So collecting delayed benefits, which is if you delay all the way until age 70, you can receive up to a 32% permanent increase in your benefits, which is huge, especially if you live a long life, and especially if you're the higher wage earner. So one of the things to keep in mind, which is very valuable about Social Security, is that there are two things to consider: spousal benefits and survivor benefits. So if you're in a situation where one spouse earned a fair amount less than the higher earning spouse, they may be entitled to spousal benefits. And how that works is if a person's own benefit based on their earnings isn't at least 50% of that spouse's benefit, well, then they can collect 50%. Now, when do they collect that 50%? They get that 50% spousal benefit if they're applying at their full retirement age, and also if their higher earning spouse is already collecting benefits. So here again, you can apply for a spousal benefit before full retirement age, but you're going to have those same 25 to 30% permanent reduction in benefits if you apply as early as age 62. And with survivor benefits, here again, how that works is essentially if you've got a married couple and one of the spouses dies, the survivor, generally speaking, we assume that both are over full retirement age at that point. The survivor collects the higher of the two benefits between the two, and the lower benefit just goes away. So you figure, if the husband makes more, he passes away, the wife collects his benefit, but her lower benefit goes away, or vice versa. If the wife makes more, and she passes away, the husband would receive that higher benefit and his lower benefit would disappear. So it's important to take into account, kind of when you claim. I will tell you that generally speaking, there's a strong math reason to wait until at least full retirement age. But in a married couple, especially if there's a disparity in income, there's an even bigger benefit for that higher earning of the couple to delay all the way up until age 70. So not only do they get that higher benefit, but a surviving spouse would get that higher benefit as well. And keep in mind that when you delay, there's generally a break-even point for that delay. And where that tends to lie based upon current rates, inflation and all that, it's not all that far past age 70. It's actually age 78. And when you look at it, 78, 79 in that range, depending on how COLA adjustments come in. But when you look at it, people's life expectancy is generally speaking early 80s. And so the likelihood of delaying and collecting those higher benefits, likelihood that you'll live to make that break-even point is pretty high. And essentially what that break-even point around age 78 or 79 is just that at that point, you've received enough from the increased benefit to make up for those couple of years that you did not take a benefit whatsoever. And then every year thereafter, you're getting that 32% increase, or, again, for someone who doesn't get their full retirement until age 67, it's a 24% increase, but it's very significant. And when you look at the difference between the, drawing at 62 and 70, it's a massive difference. And I would encourage anybody who hasn't done so recently, go to ssa.gov and get your Social Security statement. It takes you a couple of minutes to log in, get the ID set up. But you can get in there within minutes, either view or download or print out a benefit statement. And if you're below age 62, it'll essentially give you, here's my 62 benefit, here's my full retirement benefit, here's my age 70 benefit. If you happen to be over 62, it generally will tell you, well, here's what the benefit will be if you start collecting now. And if you're still below full retirement age, okay, there's that number, and then the age 70. So it's a little different for everybody. One of the nice things I like about ssa.gov as well is there are a couple of different calculators that you can go in and say, well, what if I stop working at a certain age that is before full retirement? How is that going to impact my Social Security benefit? You can also do things such as, well, what if my earnings go up? How is that going to impact it? But keep in mind, the biggest, impact on you getting a good Social Security benefit is having worked a full 35 years, which is the maximum amount of years that Social Security bases the benefit on. If you work 40 years or 50 years, they take your best 35 to base the benefit on. So if by the time you want to retire and start collecting Social Security benefits, if you haven't worked the 35 years, working a few more years to get to that 35, that'll make the biggest difference, as opposed to earning more potentially. Now, keep in mind that retirement age and Social Security age do not need to be linked in any way. We deal with clients all the time that will retire at, 64, 66, what have you, and will start their Social Security benefit at a later time that makes, the most sense for them. And, don't think that as soon as you retire, you have to start collecting. And also don't think that when you become eligible for Medicare at age 65, that you have to start collecting. It's still an option for you to choose as to, how you want to try and maximize that Social Security benefit. And the larger the benefit is when you first start collecting it, the longer it's going to last in retirement, in the sense of, fighting off the rising effects of inflation. And also COLA, which is a very important aspect of Social Security, the cost of living increases that are generally yearly, you're basing it off of a larger base the longer you wait to delay. Now, keep in mind also, if you delay past 70, there's absolutely zero benefit. So in fact, if you delay past 70, at that point, you're just throwing benefits away. So that's the very latest that you would draw. And let's see here. So part-time income. Now this is, I would tell you, become more popular. And I think it absolutely has become more popular since 2008, 2009, when people found that they were retiring right at the mortgage collapse and the collapse of Lehman Brothers, and stocks dropped like 30% that year. And so what you found is that people were, more willing to do, either delay retirement or, do some part-time. And I think with the advent of, COVID and more people working from home, I think what you're going to find too is that even for people nearing retirement age, there's going to be opportunities to work part-time from home and get paid. And so I think this will probably become something more popular over the next several years. But if you've gotten to a point where you didn't save enough, don't have enough adequate resources when you retire, that part-time income can sometimes make a huge difference, even if it just helps to offset some of your healthcare costs. So I find that I like to say that even a small additional stream of income can make a difference between a retirement plan working or failing. The other thing too is sometimes just delaying a year or two can make a very significant difference in success or chances of success in retirement, which I always define as not running out of money while still living. So withdrawals from the portfolio. This is probably the other biggie that I would say between Social Security and withdrawals from your portfolio. I find a lot of our clients, those are the two foundational pieces of income in retirement. So what is reasonable Well, a comfortable withdrawal rate, something that you can sustain for a long period of time, tends to be 3.5 to 4% of the value of your portfolio. So, my example is if you have a $1 million portfolio, that means you can withdraw about $35,000 to $40,000 a year gross before taxes, from your portfolio to help supplement your other sources of income, whether it happens to be Social Security alone or Social Security and a pension. Now, this is a benchmark, so it doesn't work for everyone. You definitely need to look at your unique situation, but it's a pretty good ballpark. I've found over the years in doing a lot of different retirement simulations that when people are below 3.5%, they tend to have a very high, chance of success, not running out of money during retirement. And oftentimes it doesn't really matter when we plan on that, how long the person might live. So ultimately below 3.5%, as long as you haven't invested overly conservatively, like mostly in cash or something, you'll find that, even if you live to be, into your late 90s, that your portfolio is actually going to grow along with you and not shrink during retirement. So, but it's important to understand portfolio returns and how that fits in. So if you expect your portfolio to earn 5% annually during retirement, you're going to need to draw less than that in order to provide returns, for returns that vary from year to year. So in old school financial planning, this is how things were taught when I first got into the business back in the late 80s, is that people would do simulations or a hypothetical. And they'd say, well, if you're drawing 5% and you're earning 5%, you're going to be fine, because you're never earning more, or you're never drawing more than what you're earning. But the reality is you can't do that kind of simplistic math. You need to take into account that returns are going to vary. You might earn 10% in one year, you might lose 5% in another. Heck, when you look at the current year, most people, even with a diversified portfolio, are down about 10% for 2022. That's really not out of the norm. And so there's going to be years when that happens, although the norm isn't going to be for that to happen. I tend to find with a more moderate portfolio over the long run, you're tending to earn 5 or 6%. And again, moderate isn't taking a ton of risk. It's usually having about 2/3 of the portfolio in the market and about 1/3 in bonds, so not in the market. So, but if you're very conservative, you need to take that into account, and your withdrawal rate might need to be even less. That's why I always say is there's a withdrawal rate that works for everyone's unique situation, but not for everybody. And then retirement confidence. So one of the things we do at Bloom and can do, it just depends on the situation, is we always look at analyzing, retirement. Are people in good shape? Are they going to be at reasonable withdrawal rates? And sometimes we even use some technology tools, software to help, build a retirement plan where we'll take into account Monte Carlo simulations, which are just, in essence, running a variety of different potential market returns. And typically the software that we use runs about 1,000 different market simulations. So you think of it as 1,000 different retirements, and then it comes back and says, well, out of those 1,000 times, how many times did you run out of money? And how many times didn't you? And that number of times that the money lasted, that's really the confidence factor. Generally speaking, when I look at a Monte Carlo simulation, I like to see about an 80% success rate. What's great about software is it can account for inflation, potential varied market returns, and even varied withdrawal rates. So if someone says, hey, I plan on taking a little bit more money out in the early years, but less in the latter years as I get older and maybe aren't, doing as much, so I'm not spending as much, that can all be done relatively easily. So it's definitely important to look at that analysis that acknowledges that market returns are not fixed and that they can vary dramatically from year to year. And so I want to spend a little bit of time about building a portfolio that works for you. And when we look at this, Bloom's general approach to investing, as is the case for many professionals and advisors, is recommending that you invest in a globally diversified portfolio. It's really critical. And so the base of a globally diversified portfolio tends to be U.S. stocks, but it's important to also include foreign stocks, so international companies, as well as emerging markets. And the reason that you don't just invest in the US is that the US is not always the best performing market. Now, we've been on a particularly good run for US stocks over the last decade where they have tended to outperform foreign stocks. But you'll find that over the long term, stocks move in cycles. There's definitely over the last 40, 50 years, very well documented evidence that eventually US stops outperforming and foreign outperforms. They tend to be, 3 to 5 year or longer cycles of outperformance. So we don't try to time the market. What we do is say, well, you got to have exposure to those areas, when it comes to stocks. And bonds are another area where when you look at bonds, you can't just be in like long-term treasuries. It's important to include some traditional bond funds that might have government guaranteed obligations. But especially now with a rising interest rate environment, it's also important to include non-traditional bonds or bond funds in there. And those would be just things where a manager will have an ability to adjust the maturity, how long the bonds have until they mature, the credit quality, and sometimes even investing internationally. So, but the best way, generally speaking, to do all of this stuff, whether it's stocks or bonds, is to use low cost, easy to understand investments that provide diversification. We're big fans of mutual funds. We also like ETFs, which are just exchange traded funds. What both of those offer is professional management, or in the case of most ETFs, passive management, but you're effectively buying very broadly invested, investments. You get a typical mutual fund that's actively managed, and they're going to own anywhere from 50 to 100 stocks, and a professional manager is determining day to day which stocks should be in there. Now, I don't recommend funds that are actively trading. In fact, when we choose funds for our clients, we generally are looking for funds that have good track records and low turnover, because for funds that are not held in an IRA, taxes are a consideration. And I would tell you that, if you're looking at funds, it's the same thing. You want to look at long 5 and 10 year track records. Doesn't matter what the fund did last year or this year. It really matters what they've been able to do over long periods of time. And again, a typical globally diversified portfolio for someone that's a moderate investor tends to be about 70% stocks, 30% bonds. In the stock piece, there's a tilt to US, but good 35-40% is going to be international and emerging markets. And on the bond side, we tend to be about 50-50 between traditional and non-traditional bond funds at this point. So diversification is critical. I like to show this chart, although I won't spend too much time on it because I think for a lot of you it probably is pretty small. But what it shows you, I oftentimes refer to this as the eye chart, is that it really shows you the best and worst performing areas, and really all the major areas of asset allocation throughout the years. And if you're like me, you'll find that there really isn't a sustainable pattern here. There's periods of time where real estate's done well, like REITs, 2010 through 2012 was the top performing area. But then there's also times where, large cap funds, like in 2019 were the top performing area, this green area. And you'll find that you tend to have periods of time when stocks do run in a bit of a cycle. They tend to be up near the top or down near the bottom. What we do, a globally diversified portfolio, is similar to this asset allocation, the white box, where it's never the top performing area, but it's never the bottom performing area. What you get from global diversification through stocks and bonds is essentially a portfolio that softens the ups and downs and also softens the returns both on the upside and the downside. So, but not a guarantee of always making money. Like if you look out over the last 14, 15 years that this chart shows, you'll definitely see there's times when even a properly asset allocated portfolio in 2018 lost about 6%. And 2011 was another year where, in fact, 2015. So there's really, 3. And 2008 was probably the worst. It's hard to see because there's the line going through it. Even a properly asset allocated portfolio was down about 25%. So there are going to be years out there. But why does diversification pay off? Well, it's really this next chart. And it can feel disappointing in the short term, but it definitely has longer term benefits. So when you look at some of these time frames over the last 20 years, I like to look at this is that, 2000 to 2002, the S&P was down 40%. Just an absolute horrible time for the market. However, a diversified portfolio lost 17%. So oftentimes people are going to say, well, I was diversified, I lost money. But I would argue that losing 17% is much better than losing 40. Then in 2003 to 2007, it was just a bang up range of years for stocks. The S&P picked up 83%. Diversified portfolio only did 80 over that time frame. So I didn't make as much money. Here again, 2008 comes back to a bad year. I lost money, but again, not as much as the S&P 500. And in the really, kind of what I call post, mortgage debacle years, it was really a fairly long bull market from 2000 to 2019. The S&P 500 did phenomenal, earned 351%. And again, a diversified portfolio was only up about 195. Still a great return for that time frame, but you're going to walk away saying I didn't make as much money. 2020 pandemic comes around, you lost money again, not as much as the S&P. And then, in the boom time, which was really just a quarter afterwards, 2Q through Q4 of 2020, you didn't make as much money. But what you'll find is that over that 20-year time frame, the diversified portfolio still comes out slightly ahead. And that's, in dollar terms, that portfolio was about $7,000 ahead, 375,000 versus 368. Total return of 275% versus 268, but a lot less volatility over those 20 years. And, this portfolio, was essentially, 40% S&P 500, 10% international stocks, another 5% small cap US. So it was essentially, and then 30% bonds, 10% corporate high yield. So it ends up being between all of that, about a 60-40 portfolio, broadly speaking, 5% in those emerging markets as well. So a little footnote says there, but 60-40. So even with a relatively low risk portfolio, you beat the S&P over the last 20 years. So we're big believers in diversification for that reason. So how should I prioritize saving for retirement? So primarily, you want to optimize pre-tax employer plans and make sure that you're taking advantage of a company match. So if you're working for a company that offers a 401k, most employers will match anywhere from 3 to 5% of your earnings, as long as you're contributing that same 3 to 5%. But it's important to check in with your employer, find out if there's a match. If you're not at least contributing up to that company match, you're literally just throwing money away. But as a general rule of thumb, I like to see people, socking away, 10% or more of their pre-tax earnings towards a 401k. A secondary approach, if you're eligible, is to consider contributing to a Roth IRA. Sometimes, with a dual income, high earning couple, you can actually make enough, too much money where you don't qualify for a Roth IRA. But if you do qualify and you have the funds available, you can contribute to a Roth IRA as well. What's interesting about a Roth IRA is earnings are growing tax-free as opposed to a pre-tax 401k or 403b where your earnings are just growing pre-tax, so they're growing tax-deferred. Eventually, when you take money out of a 401k, for every dollar you take out, you're going to pay taxes on it. With a Roth IRA, for every dollar you take out, zero tax. So, and really the third option, and kind of in order of priority, is you can invest in a non-retirement account, so a non-401k, non-Roth IRA. But if you're going to do that, you want to use tax-efficient investments. And I always say is that non-retirement type of account, something that might be in joint name or trust name or individual name, something like that, that account comes into play primarily when you've maxed out the other savings options available, or if you're trying to save up in a non-retirement account for money that you want to access prior to 59 and a half. So if you dip into a 401k or a Roth IRA prior to 59 and a half, generally you're looking at not only taxes, but also penalties. So they gain their benefits when you're drawing after age 59 and a half. And what about annuities? So I'm not a huge fan of annuities in general. I think annuities generally are sold, not bought. And what we're often told is, well, your principal will be protected and you'll get stock market returns. And I tend to find is that when stock markets are down like they are right now in 2022, the annuity salespeople come out of the woodwork because they know if you're a regular, kind of traditional investor with a stock and bond portfolio, you're experiencing some losses. And that pitch, about, keeping your principal safe tends to ring, pretty well. But you need to keep in mind that annuities are complex insurance products, and oftentimes they'll have 50 to 100 pages of documentation that you need to, kind of fully understand it. Participation rates are an important key thing if you're looking at an annuity. That tells you how much of the stock market return you might get, and sometimes they're as low as even 2 or 5%. And participation rates do not include dividends nor reinvested dividends. There's also caps on returns. So oftentimes those returns can be capped as well. So stock market does 30%. Well, what if the cap on your annuity is 5? You get 5%, not the 30. And there's surrender charges that typically almost are always involved with annuities, oftentimes as long as 10 or 15 years. And as a result, you can pay very significant penalties if you find out over a period of time that the annuity was not right for you or not, working out as sold. So I would say be very cautious, be very mindful of fees, and make sure you understand how they work if you feel like that's something that might work for you. Now, a little different angle there, I would say, is what annuities could make sense for retirement or a retiree, as opposed to fixed annuities or something like that, is an immediate annuity. Sometimes it makes some sense to take a portion of your portfolio in exchange for an immediate annuity, which provides a stream of payments, much like a pension. So immediate annuities can be a viable pension alternative or option for folks, especially if you primarily just don't have a pension and have saved significantly within either an IRA or other type of account. So maximizing your retirement income by minimizing the taxes. So this is really talking about, sort of order of withdrawal. When you think of taxes, they depend heavily on which accounts you draw from and in what order. So my general priority prior to age 72 is to follow the order that I've laid out here. Which is non-retirement accounts first. The reason that you want to draw from non-retirement accounts first is that any earnings that you have on that, although they haven't been tax deferred, they're only taxed at the long-term capital gains rate. For most people, that's 15%, but for some people, the long-term capital gains rate is actually 0. So the lower your income is, if you're actually in the 12% bracket or lower, your capital gains rate is 0. But for folks that are in the 22% or higher bracket, it's generally 15%. So still, lower than your ordinary income rate. Second in line is drawing from either IRAs or annuities. That income is taxed at your ordinary income rate. So again, that's the second highest rate. And then the third order would really be, Roth IRAs, completely tax-free. And I find for most people that I work with, unless they've saved a significant portion of their retirement funds in a Roth IRA, the Roth IRA is something that you'll probably never dip into in retirement. It's money that's going to go to your beneficiaries on a tax-free basis. Now, once you're age 72, you need to prioritize a little bit differently. And this is because that's the age where minimum required distributions come into play. So all that fabulous money that you've been tax deferring in an IRA for a number of years, your minimum required distributions is really the IRS telling you, you need to take a certain portion out every year and pay the tax man. So that starts off at age 72. It's about 3.7% of the value of your IRA accounts. So, and what's interesting about that is at that age, that's generally a reasonable withdrawal rate too. But what you'll find is that as you age, that rate goes up. So for someone like my mom, who's in her mid 80s, she's actually between a 6 and 7% withdrawal rate based upon what the IRS tells her she has to. So at age 72, you'd really prioritize IRA accounts first, until you've at least satisfied your minimum required distribution amount. Then you can backtrack to non-retirement accounts, and again, eventually Roth IRAs, which again, I don't think most people dip into. However, there is the minimum required distribution time bomb that sometimes affects people, and this can change the order of withdrawals. Now, this comes into play if you've been an aggressive saver using pre-tax employer retirement accounts, 401ks, and things of that nature. So you may have saved enough that your minimum required distribution will require you to take more than you're going to need for income purposes once you reach age 72. So for instance, say you plan on needing $20,000 from your investments to supplement Social Security and live comfortably. But let's just say you've got that $1 million IRA or 401k. So at age 72, you're going to be required to take out about 37. I'll just round that up to $40,000 a year in required forced withdrawals. So that's about, anywhere from $17,000 to $20,000 more a year than you plan on needing for income. So if that's the case, you consider changing the priority for income withdrawals prior to age 72, and you actually place the IRA account withdrawals at the top of the list. Now, what's that going to do? It's going to cause that income in the early years to be taxed at ordinary income rates, but it's also going to shrink your future minimum required distributions because your IRA will end up being smaller than it otherwise would have if you had just let that growth defer until age 72. So the other thing you can consider doing is if you don't really need the income from your portfolio prior to age 72, instead of drawing from the IRA and just taking it as income, you'd consider converting a portion of your traditional IRA to a Roth IRA instead. And then that money, although you're taxed at it as at the time of the Roth conversion, then the money just grows completely tax-free, as opposed to being reinvested, say, in a non-retirement account. And I would definitely, as we're getting here on the 7:15, we're almost there to get into the Q&A. Definitely just want to mention about if you want to learn more about the team at Bloom Advisors, you can visit our website. Where we've got timely blog posts, some of them written by me. And we also have our webinar information for upcoming webinars. And there's a mailing list that you can sign up for as well if you'd like. And questions, we will definitely proceed to those at this point. Maggie, I'll let you take it from here.
Okay, we've got one question. It's kind of a long one.
All right.
This is from Dave. I'm 62 and in retirement, making monthly withdrawals as needed from my 60/40 diversified investment portfolio for living expenses. I also have 3 years worth of monthly expenses in cash reserves to bridge market turndowns. When is the right time to pull from these cash reserves in the market downturn, leaving my retirement portfolio alone? Is this when my retirement portfolio is down 1%, 5%, 10%, or 20%?
Great. That's a great question from Dave. And I'll tell you, realistically, having three years worth of monthly expenses and cash reserves is more than enough to bridge market downturns, because you'll find that generally market turns don't last that long. But I would tell you, as far as a specific percentage point, I think it's more about, how long does the market correction occur for? So in other words, if you're drawing, monthly, what I like to see people do is to have at least about 6 months worth of withdrawals just sitting in cash. And what you'll find is that during that 6-month time frame, if you're just drawing down that cash, you're going to be fine during most market downturns. Some market downturns last longer. The one we're in right now may do that. And what I would tend to do, though, is look at replenishing that cash reserve, that 6 month, if ultimately it needs to be. So with a case like yours, having 3 years worth of monthly expenses, I'd probably look at my trigger point as far as, when do I draw from cash versus the portfolio? Probably about that 10% mark, to be honest. And then, realistically, because you've got so much set aside, draw from that for a period of time until stocks have recovered. And then at that point, flip back to drawing from your 60/40 portfolio. Yeah. Yeah. But I think 10% is reasonable, so that you're not chewing up the principal of your 60/40 portfolio.
Okay, we've got another one from Jim. How do I find good tax efficient investments? What is the number in the prospectus that I should look for?
Yeah, so I tell you it's a good question, but not always easy to answer, because ultimately, when it comes to tax efficiency, they tend to change. So if you're looking at index funds as an example, they tend to be, by their very nature, fairly tax efficient. And so, you're really, with a decent index fund, you're really looking at like a turnover rate that's very low, and dividend distributions that tend to be around 3%. So if you're looking at Morningstar, oftentimes you'll see, tax efficiency ratings. And, again, lower are better, but I think you really want to focus on the turnover rate and really looking for funds that, have a turnover rate below 30%. And the reason I mentioned Morningstar, they're independent, but they do a lot of analysis of funds that are out there. And it's usually really easy to get numbers like that. Now, in the prospectus itself, this is kind of the funny thing, because that was part of the question, right? Was, where do I look in the prospectus? You won't necessarily find an easy turnover rate number in the prospectus, but what you will find in the prospectus is typically the last 5 to 10 years worth of distributions. And you can do a little math on that yourself just to see, what those distributions have looked like. And the other spot you can look at very reliably is the fund company's website. They'll tend to have that as well. But we look at, again, generally we like to see 30% or less turnover. And again, with the indexes, generally, 3 or less as good numbers for distribution payout.
Okay, got another question. I'm 6 months away from FRA, looking for retirement financial advisor.
Right.
The only fiduciary expensive, and some advisors just want to sell me things. Is there an optimal way to get advice?
Yeah, so it's a great question, and the question that you have is really the heart of what we do. Is so I didn't explain a lot about Bloom Advisors, but we are a fee-only fiduciary. And so, but they're not all expensive. It just depends on, kind of relatively speaking, what your thought process is on what is expensive. So we are, like, our standard rate to manage money is 1%. And when we're managing money for an advisor or for a client, not only are we managing that portfolio, we're also giving them a variety of, retirement planning advice and other, financial advice that they may need. So it's all wrapped into that 1% fee. And I would tell you that the rate that we're at, I'm actually finding that we're a little bit below the industry average. The industry average tends to be, closer to 1.25% to 1.5%. But I've seen fee-only fiduciaries as high as 3%. And to me, that's too expensive. There's also, other ways that you can look for advice and still get a professional. We used to do, years ago, hourly type of planning. And what we found is that we just weren't doing enough of it to justify that as a line of business. And, but there still are folks out there that provide, fee only hourly advice. I'm sure if you Google, user-friendly Google.com, you can, get some people even in the area. So key thing to keep in mind, though, is really, what are you getting? So if you're doing hourly planning, you're really going to have no follow-up and generally no answers to questions after that. But it is going to be a cheaper approach as opposed to, paying a fee-only fiduciary. The big upside you get from a fee-only fiduciary is that, and I think this is important for retirees, is as you age and maybe don't want to keep up on this stuff yourself, that the advisor is, as long as they're doing a good job, they're handling things for you, not only managing the portfolio and producing good returns, but they're also handling the cash management side of it. So, when you get to retirement age and start needing a monthly check from your portfolio, well, the fee-only fiduciary is going to do that for you. When you hit age 72 and you need to start taking required minimum distributions, a fee-only fiduciary like Bloom is going to make sure that happens so that you don't miss it. And again, they're on hand. So it really depends on, what you feel is right for you.
Now, Scott, you might want to mention what a fiduciary is, because some people might not know.
Yeah, no, it's a great point. So, and thank you, Maggie, for that reminder. Is a fiduciary is really by definition someone who puts the client's needs first before their own. So, one of the things that's very common with fee-only fiduciaries is that we don't sell commission products. So there's really not that conflict of interest that you might have. So, in the traditional finance world, where you don't have fiduciaries, you really have what they call the know your customer rule. So, brokers that sell products and are compensated on commission, they're held to a different standard that really holds that they need to make investment recommendations that are appropriate, but not necessarily putting the client first. And, when you're dealing with a fiduciary, we're really, by law, we have to put our needs secondary to the clients. So, yeah,
Okay.
thank you.
Here's another question from Patricia. How do I calculate retirement expenses when it feels so undefined? Where I plan to live in a condo, how to plan to live, enjoy the city or travel. I'm not even sure if I will use mass transit or need a car. I'm 47, retired early with a husband at 43 currently, looking to retire at 50.
Right. So, and that it's tricky, right? And I would tell you, I don't know that I really have an easy answer for you, other than you got to sit down and do the hard work of planning. And when I say planning, just really making some of those decisions as to, do you want to, move to a lower cost area, or, are you going to end up moving to an area that's about the same? Like I've read articles, in magazines over the last several years that sometimes folks would consider moving to Mexico, for instance, as a way to have dramatically lower expenses. But there's a lot of trade-offs when you do something like that. Just like if you move to a place like Florida, oftentimes you're going to have higher expenses than here in Michigan. And so really what you can do, though, is you can absolutely do some research on this as to find out, cost of living. And I always tell you, in cases like this where you're trying to find out things that you really haven't decided on yet, is Google is your friend. You can Google things such as, where's the best place to retire? And what you'll typically get is a list of, low cost places to live. And you're also going to have at the very bottom of the list high cost. And you're going to be able to look at Michigan and say, well, where do we fall in between there? And but as far as, condo versus a house, there oftentimes isn't a big difference between those two. When you think about it, that, a condo is just a lifestyle. You can live in an expensive condo, you can live in a cheaper condo. Yeah, but, if you buy a condo that's relatively the same value as the house that you may be living in now, you're going to find that there's not a dramatic difference in expenses. And I'll give you as an example. I used to live in a ranch in Troy. I moved into a condo a number of years ago. Why did I do that? Because I like the creature benefits of the condo. I live at a condo that's got a pool and a tennis court. Now, I don't use the tennis court, but I use the pool all the time during summer. I love it. And condo living can be great. But you have an association fee. And sometimes people will say, well, okay, because of the association fee, the condo is more expensive versus, owning a home. You just pay off your mortgage and then you're all set. But the reality is a condo fee is just really a culmination of other expenses you'd have if you owned your own home. So my condo fee covers cutting the grass, shoveling the snow. It actually includes water, as well as some of the other amenities. And when things like roofs need replacing, well, it's a collective. The roofs are replaced across the entire complex. The entire complex pays for it. If you own your own home, you're still going to have to replace your roof someday. It's just going to be you and yourself making that decision. So I'd say, if you're planning on retiring 7 years from now, probably the biggest thing to think about is inflation, and then really roll up your sleeves to try and determine, if you haven't already, how does your life in retirement look different than it is today? But I'd still say at the bottom line, you got to get back to paper and pencil or spreadsheet and putting those expenses out there. Just be as specific as possible.
Okay, do we have any other questions? I have a question.
Sure,
If
Maggie.
you have a 403B and you live a long time, but then you don't use it and you leave it for your beneficiaries, what happens? Do they pay the taxes on like the 403B if they inherit it? How's that work?
No, they absolutely do. So when an inheritor, especially if they're a non-spouse beneficiary, inherits, whether it's a 403B, 401k, or an IRA account even, tax laws used to provide for an ability to take that money either as a lump sum over 5 years or for your life. But now what's happened as of the Secure Act that passed, a couple of years ago, is there's only a 10-year time frame for that 403B that you asked about to be paid out. So if it's a non-spouse beneficiary, they have 10 years to pay it. And they, as the beneficiaries take distributions, they're paying ordinary income tax on those distributions. And if someone's inheriting a Roth IRA, it's that same 10-year time frame, but of course they're not paying taxes. So what I tend to recommend, if someone is a non-spouse beneficiary inheriting an IRA or that type of pre-tax account, they should spread those distributions as evenly as possible over the 10 years so that they have the lowest tax burden in any given year, as opposed to taking it all up front or all at the end. Roth IRA that's inherited, though, is just the opposite. I tell folks to basically use the 10 years, let that continue to grow tax-free, and in year 10, take the full distribution on a tax-free basis.
Okay, we have another question. Should I-bonds be considered currently for cash over and above emergency fund?
Yeah, you know what? I would tell you that as long as your time frame for investment is at least a year or longer, I-bonds are a great consideration. Now, keep in mind that you can only invest $10,000. That's like the max for any person to invest into I-bonds. And right now, the rate that's just resetting in May is going to be about 9%. So it's paying a really great rate. But I-bonds move with inflation. So the last rate was 7.6. It's jumping up to 9. Eventually, when inflation comes down, the rate on the I-bond is going to come down. They reset every 6 months. And you have to initially leave the money in there at least 1 year. When you cash the money out, you lose the most recent 3 months worth of interest. And they're designed with the idea of being at least a 5-year holding. So if your time frame is right for that cash over and above an emergency fund, I-bond can make a lot of sense. But if you're going to need it within, less than a year, an I-bond would be a bad choice. Yeah, because it wouldn't give you the flexibility.
Okay. Any other questions? Looks like there are not any questions. Oh, here one.
All right.
Given a 7-year retirement horizon, the person's going to be 50. Do you recommend an 80% stock mix or something more conservative? We have multiple accounts, IRAs, Roth, regular mutual funds. Based on your presentation, maybe the regular fund is more conservative and the qualified plans are more aggressive?
Oh, gotcha. Yeah, so with a 7-year retirement horizon, I would tell you, you still have the ability to have an 80% stock mix. So that's something in my mind. 85% tends to be more aggressive. But I would tell you with 7 years to go, that's fine. Where I tend to throttle off and would think it would make more sense to be a little bit more conservative, maybe like a moderate, is when you get into that final 3 to 5 years. And again, 3 versus 5 really depends on your own personal tolerance for risk. But very rarely does it make sense to be in those final years of retirement, like that last 3 to 5, or certainly in retirement, and still have 80% in stocks. Generally the most I'd like to see retired folks have in stocks is, about 70%, which again would be more moderate. But as far as which account, honestly, I like to use non-retirement accounts for stocks, especially index funds, because they're the most tax efficient. But as a result, they tend to be the most aggressive. So when you think about your allocation, it's really the culmination of all the accounts, not just the one. And that's what I tend to do even in my own personal is, my non-retirement money is my most aggressive, even though I'll probably tap into that the first, sooner than other monies. And the reason I think that that works still is that it's aggressive relative to an entire portfolio that's more, moderate.
Okay, well, I think that's it, Scott. Well, thanks
Great.
a lot. And one more. Thank you very much, Scott. And thank you, Chris. And I think people enjoyed it. And we
Great.
are going to, this is being recorded, so we do have some archived programs on our website. So that'll be on in a few weeks from now. So thank you
Great.
again, Scott. And
thank you, Maggie. Appreciate the opportunity.
Hopefully a great summer, and stay safe. And thanks again.
Thank you. We'll talk to you soon.
All right. Bye-bye.
Bye-bye.